Well, hello, everyone, and welcome to another session of the SBH Investment Summit. I'm Alexis Can, and I'm very excited to be your host for today's in-depth discussion on the U.S. small cap value landscape. Today, we will be discussing the underlying themes and trends that are shaping today's rapidly changing market. We'll discuss potential challenges ahead as well as opportunities. And lastly, we'll discuss how our team at SBH is positioning our portfolios to achieve success for our clients. To help us navigate through these different topics, joining our discussion today is Shaun Nicholson, Senior Portfolio Manager on the Small Cap Value and Small Cap Value Select strategies. So without further ado, let's get into our first question. So Shaun, let's start with how you're navigating the ongoing volatility, especially within the industrials and healthcare sectors. And additionally, what key trends do you anticipate will shape the future of these industries moving forward?
Yeah, thanks, Alexis. When I look at the industrial space, it's been through quite a bit of change over the last few years. You had the supply chain issues post-COVID. You had the rapid inflation backdrop where they were trying to raise prices fast enough to maintain their margins. And I think as things have settled in here, the volatility is kind of turning away from those areas and into more of the true end demand for the products that the industrial companies produce. So I think at this point, the volatility is really understanding where the global economy is going to go. And I think that's the biggest challenge within that space. I do think there's some called secular drivers for the time being that are going to help these companies, particularly some of the fiscal funding that is now available. If you may recall, we passed the infrastructure spending bill a couple years ago. We have the IRA bill. We have the CHIPS Act. We also have some broadband funding for rural broadband. So all combined, those are close to $1 trillion of spending here more in the U.S. that will be helping these industrial companies manage some of the demand challenges or forecasting that demand challenge going forward. So it kind of time will tell on where the economy goes, but I think overall the volatility is settling down into more the true end demand side of it versus some of those factors that came out of COVID. Within healthcare, that's quite a bit unique space. Currently, the volatility there, they also felt the inflation challenges that emerged post-COVID as well as some of the supply chain challenges. But what we're seeing today is more within the healthcare group is kind of excitement around certain drugs that are coming to the market. And in particular, the GLP-1, as they're called, drugs that are predominantly used to treat diabetes are now being also used to treat obesity and weight loss. And I think some of the market participants are assuming that this could be a savior for the healthcare system in terms of the success rate of those that will no longer need all the services that they may have had in the past if they end up becoming more healthy by losing amount of weight that this drug can cause. So I think that's something that's very new today, that we're just entering into this world in the healthcare space of what will this drug really create from a backdrop of healthcare service demand. And I think that's something we don't know and no one does at this point. It's still, again, very early, but that is volatility in the space has really been caused by that here recently in terms of trying to determine the uptake of that drug and the success rate of that.
Another contributing factor to the volatility this year has been, the Federal Reserve's rate hiking campaign. We've seen rates increase by more than 5 percentage points since last year, and they currently stand at their highest levels in 22 years. So how has this impacted the banking industry, and do you believe the full repercussions of these rate increases are still unfolding?
Yeah, in terms of the bank impact, I think most of the impact has really been thus far on the cost of funding for banks. So when you look at how banks fund their loans that they lend out to their customers, it's mainly through deposits. And what you've had for a very long time is very low cost of those deposits. And when the Fed has given the Fed raised so fast up to that 5% level, what you have seen is people wanting more for those deposits. And so they're competing with the treasuries in terms of yield to provide their customers. So what the banks have had to do is absorb that higher cost of capital in terms of the impact of their net interest margin. Now, on the other side of that, what they're going to be going to the market to offset that is higher loan pricing. And if you look at where loan pricing was a year ago, it was around 4 to 4.5% on average. Today, if you're going to go get a loan, you're looking at 8 to 9%. And so I think that impact will help the banks in some regard recapture some of that lost margin that they've had to deal with from the Fed hikes. However, what could happen is more of a credit issue emerge as their customers have to now pay much higher interest costs on the debt that they do have. And I think that could also slow down loan demand, which could actually impact the economy from a growth standpoint. So I think we're still, the full impact of these rate increases have not been absorbed by the market. I think that will come over the next 1 to 2 years. But in the interim, I think most people are hoping the Fed starts to cut rates sometime in 2024, which will alleviate some of that stress. But that's still a little uncertain at this point, given where inflation is relative to the target that the Fed is trying to achieve.
So given the trends and factors we've discussed today, for our last question, how are you positioning the strategy and what areas of risk as well as opportunities are you watching as we approach year end and look ahead to next year?
Yeah, I think the portfolio is positioned not much differently than it has been in the recent past. I think we have really tried to understand the true end demand across many industries, because we've gone through, again, coming out of COVID with the supply chain, with inflation. I think you saw a lot of over ordering across many different areas because people were uncertain they would have the product. And I think now, as you're settling into what the true demand is, there's too much product out there. And so right now we're trying to position the portfolio into those companies in particular that have the self-help, as we call it, the ability to run their business differently than it was in the past. And that's usually through understanding a different strategy of go-to-market, getting out of markets that are commoditized markets, and really pivoting the focus and resources of each of these companies in our portfolios, pivoting them to areas that have much better growth characteristics as well as better profitability and return on invested capital characteristics. So I think that has not changed. I think from the risk standpoint, we are clearly watching the higher cost of capital, as we talked about with the banks. You know, if you're going to the market now, you're going to pay a lot more than you were to borrow money. And I think if you have debt that's going to refinance, you're also going to be paying a lot more. And so that higher cost of capital has to be absorbed and offset within these companies. And so we really are paying much more attention on that side of the risk equation than we would have a couple of years ago when rates were very low. So I think we've tried to stay away from levered companies. And if we do have some exposure into companies with leverage, they have a very solid strategy to delever the balance sheet through their own actions. And so I think that's kind of where we're at today in terms of the portfolio positioning. You know, we maintain an overweight to industrials and underweight to financials. And I think generally not seeing a tremendous amount of change that we foresee coming with that position. But as things develop, as we move into next year, we'll get a lot more information on the Fed. And I think that will determine some of the market structure and where our portfolio may have to move from a positioning standpoint.
Well, that was our last question for today. So as we wrap up this year's summit, I want to say thank you to Shaun for being part of our discussion and sharing your insights with us today. I hope that the information we've shared will provide a deeper understanding of the current state of the small cap value market. But if you have any further questions or are interested in learning more about any of the topics we've covered today, we'd love to continue the conversation with you. So please don't hesitate to reach out to your relationship contact at SBH. We look forward to having you join us at our next summit. And until then, thank you for your time and for being part of today's discussion.